Is the Australian property market going to boom or bust in 2019? Is this the year that the bubble finally pops? In today's video, I'm going to explain some of the positive things and some of the negative things about the Australian economy and property market in 2019. Today's video, I'm going to review some of the data from Heron Todd White, some of the data from CoreLogic. I'm going to look at Warren Buffett, Ray Dalio's, Fred Harrison's, Phil Anderson's thoughts on the economy. I'm going to look at some of the data from KPMG as well as people like BIS Strathmore. So this isn't Ben Everingham's thoughts. This is purely some ideas based on what's happening and what other people in the marketplace are saying. Now, Heron Todd White looks at Australia and they produce a great report each month which produces a property clock of where the different marketplaces in Australia are at any point in time. And that's what you've got to remember about Australia. It is not one market of Sydney or one market of Melbourne or one market of Australia. There are a number of capital cities, there are a number of regional areas, there are a number of smaller areas in Australia, and all of them are constantly working on different cycles. So Heron Todd White's latest report are putting Sydney, Melbourne and Perth in the declining phase of the property market right now, which anybody who hasn't had their head in the sand for the last year and a half knows that that's been going on in Sydney and Melbourne for that period of time. And anybody that's been thinking about this stuff for the last 5 years knows that that's where Perth's sort of been for quite a while now. Now, the metro markets in Australia that are at the rising stage of the property clock, according to Heron Todd White, are Brisbane. If we talk about a regional perspective, they're putting the Gold Coast at approaching the peak of the marketplace. If we talk about the major regional markets in Australia, they're putting the Sunshine Coast at about 10 o'clock, approaching the peak of the market. The Gold Coast is starting to decline. Wollongong's in the declining phase. Newcastle's in the starting to decline phase, and Ballarat's in the rising market phase. Now, I know there's a huge amount of extra markets in Australia. You can jump over to Heron Todd White and have a look at that, but that's sort of what they're saying in their December 2018 report, and I think that's pretty accurate, having followed their information now for the last 4.5 years. Now, CoreLogic, who is Australia's leading analyst and provider of property investment information and data and analytics, and I believe the most accurate forecaster of where things are going in Australian property, because they're the guys that have been collecting the data now for almost 20 years, are saying the overall trend, if we look at Australia as a whole over the next 12 months from a property perspective, is on the decline. If you look at the average return in Australia from a property as Australia as a whole last year, in 2018 it declined by 4.2%, but there's properties that I own that went up by 15% last year in southeast Queensland. There's other properties that people own that went down by 20 or 30% in different parts of Australia last year. So you've got to remember it's a big market, and with 55% of the marketplace or the value of property assets in Australia being in Sydney and Melbourne alone, when you look at the big picture data, because Sydney and Melbourne are declining now, it's pulling the rest of Australia's averages down with it. But I think within those averages, there's also great opportunity. Now, if we look at Sydney and Melbourne since the last top, Sydney has declined now by about 9.5%. If it declines by over 9.7%, that is going to be the largest decline in property values during a declining phase in the last 30 years. So that's a pretty big deal for Sydney. Melbourne since the top, according to CoreLogic's, declined now by 4.8%, where in the last 12 months, Hobart, Adelaide and Brisbane, as well as the Sunshine Coast, Gold Coast and a bunch of other markets like Geelong, all recorded really positive growth. Now, what I love about CoreLogic is they don't just spray data out there, but they give reasons for what is going on right now. Now, the number one reason all of this has occurred, and if we look at previous cycles over the last 30, 50, 100 years, generally property prices decline either during a recession or a depression, or because interest rates are rising. But this time round, the Australian government kind of went, banks, you've been fucking out of control in Australia since the last GFC. You've been giving people money Too many people have been speculating on Australian property in Sydney and Melbourne. We're going to tighten policy, we're going to tighten credit, and we're going to make it really hard for investors or the average investor to go out there and keep spruiking or purchasing property. Now, that's completely cool. So tightening finance is the number one reason. Obviously, the rental returns in Sydney and Melbourne right now are absolutely horrible, sitting at just over 2%. So that's a disincentive for investors. The internal and external migration rates into Sydney and Melbourne declined a little in 2018. A lot of Australians are now moving into southeast Queensland. That's the fastest growth area from a population perspective now. It's, no wonder when property prices in Sydney are 100% more expensive than they are in Brisbane, or 60-70% more expensive than they are in Melbourne than they are in Brisbane. It's no wonder that people can actually come over the border here and start looking at this marketplace as well, particularly now that the average household income in Brisbane is actually higher than the average household income in Melbourne. Particularly now the average household income's higher in Brisbane than it is in Melbourne. Now, over the last 18 months in Australia, the sentiment from a media perspective around property and online and in the newspapers has been really negative. You've got stories that aired last year that are saying the Australian economy / property marketplace is going to crumble and drop by 50 or 60%. You've got other people with all sorts of different opinions, which has meant over time those different ideas, whether they're true or false, the future will tell, have been rippling through the economy, and that is something that you need to take into consideration. When sentiment's low, there's less buyers, which as a person who is more of a bearish investor, which means I like to invest when markets are down or there's less people in the market to compete with. I like these opportunities, but most people don't like seeing blood on the streets, which is when asset prices and property prices are declining and they wait until everybody else is back in and then they're paying more than they need to for the product or the asset. Another thing that's happening is mortgage rates have slightly increased over the last 12 months. It's really just the banks getting a bit of a cash grab while they can and increasing rates. Nothing has happened to the official Reserve Bank of Australia cash rate for a long period of time. So it's just the big old greedy banks doing their thing again and increasing rates so that they can take more. Government changes that could come in this year as well. If the Labor government gets in, they're talking about potentially some changes to negative gearing, as well as some changes to capital gains taxes might have an effect on short-term sentiment. Although based on my analysis of history, based on Phil Anderson and Fred Harrison's work, it doesn't look like government, or to too much of an extent government policy, that is just sort of scraping the surface as opposed to going to the root cause of housing unaffordability, really has too much of an effect on long-term prices. Now, that's kind of like the reasons why, according to CoreLogic, but Tim Lawless did say at the end of his video and his update on 2018 that GDP was above average, which is a positive thing. Unemployment rates are historically low. Interest rates are historically low. The banks have finally hit the level that APRA set for investment lending, and talking to my mortgage broker who's been in the game for over 20 years, owns 25 properties outright and writes a lot of loans across his businesses, has sort of said that he begins to see things softening up in quite a big way over the next 3 to 6 months from an investment lending perspective. There could be a reduction in the official cash rate over the next 12 months if required by the Reserve Bank, which means rates are probably actually going to go down as opposed to up, which is cool. Population growth has been phenomenal in 2018. It looks to be strong in 2019 as well. For anyone that hasn't done this, if you look at the Australian government's plan for Australia, you're talking 60 million people over the next 50 years. That's the population size, so we're almost going to triple. I think from that perspective, that is why England and the UK had such a strong run in the past, because they sucked in a lot of migrants from around the world. Then after England and that got too busy, everyone went to America, and during that period of ridiculous prosperity in America, it was a result of that very, very high population growth. You've seen the same thing in China and India. As those populations have exploded, the affluence has moved with it. Now, 60 million people sounds insane right now for Australia, but I will see that in my lifetime. And as long as that population growth stays strong and we select the people that are coming to Australia to those that have money, then those people are going to want to buy houses, start businesses, need jobs, and the cycle goes on. Wages have also grown above what they expected as well, so that's another positive thing. Now, just flicking my little page here, Phil Anderson, who I absolutely love, he wrote The Secret Life of Real Estate and Banking book. He's an Australian economist who's been doing property and shares now for the last 40 odd years. Talks about this 18-year overarching real estate cycle. He believes that we're about halfway through. What we generally see halfway through, according to Phil, is what they call a mid-cycle slowdown, which at some point over the next few years, he assumes, based on history of America, we'll see a pretty significant decline in stock market and share prices across the ASX and the S&P. Potentially at this stage is when things can get a little bit rocky. We might see a recession in America, which might have a flow-on effect to Australia and other parts of the world. A technical recession. We're not talking about a full-blown, like some people are saying online, depression, recession that's going to last years. It's going to be as bad as the Great Depression, the whole world's fucked type thing. We're just talking about the mid-cycle slowdown point. And the reason it's a mid-cycle slowdown is because a lot of institutional investors still have big money. A lot of businesses still have big cash reserves. A lot of investors around the world have just been stacking cash since the last GFC. Not everybody's all in yet. Where when we get to the top of like a Great Depression or a GFC or a recession we have to have, if you look at your history in the UK and America over the last 200 or 300 years, everybody's all in. There's no cash left. The government's all in because they've been spending on infrastructure, which we'll see a lot of over the next 7 years in Australia. And the banks are all in there, leverage to the hill, and all of a sudden, boom, the whole thing blows up and we see a really bad event or a really opportune event if you're a smart investor. Now, he believes it's going to be more stock orientated. Obviously, property prices in many parts of Australia have already started to decline over the last 18 months. In real terms, whether that's being recorded yet or not, we'll see. He believes it's a good time to save some cash, buy distressed assets at great prices, and value invest, which means, same as Warren Buffett's thoughts on the next few years, buy really, really good quality assets at good prices or fair prices, as opposed to buying at the top, which is a lot of people do. You saw that last year in crypto. You've seen that last year in the American stock market with Bloomberg reporting. A lot of mums and dads are all in right now, where a lot of institutional investors and smart investors are sitting on the side. Ray Dalio, who runs Bridgewater Associates, the most successful hedge fund in the world and the top performing hedge fund, I think, of all time now, is basically saying that he believes stocks, commodities, and some property markets around the world are fully priced right now. And the result of the last GFC was governments all around the world and banks loosened their underpants basically and effectively gave out free stuff to everyone, gave out cheap money. They call it pump priming an economy. All of that cheap money has now flowed into assets, which are very, very expensive right now from a real terms perspective, and that's why over the next couple of years we'll see flatlining across some property markets, a decline in some property markets. Obviously some property markets will go up because they haven't experienced growth since the last GFC, and potentially he's saying an effect on the stock market or share markets around the world as well as those assets and commodity prices come down slightly. His thoughts is, like all smart investors, buy when there's blood on the streets. I hate saying it that way, but that means just buy when others aren't. Be fearful when others are greedy, as Warren Buffett says. His approach, same with Warren, same with Phil Anderson, same with all of the great investors, is buy for the long term. Now, I personally, as an investor and as a business person, do not care about my 12-month returns on my investments. I'm looking at things from a 10, 15, 20, 50-year perspective. Now, what happens with a cycle, and we've got to remember it's a cycle, in any cycle there's a bottom, there's an upward phase, there's a top and another declining phase. That is the same with property, and For some reason, a lot of investors in Australia have a recency bias. Stocks have been going good, super's been going good, property's been going good. They forget that that doesn't always happen. So it gives investors like myself, potentially you if you're smart, an opportunity as fear continues to spread through the market to buy assets at better prices than I could have done, say, 12 months, 2 years, 3 years ago, which who doesn't want to do that? KPMG has said that they believe Sydney and Melbourne, KPMG is a big global consultancy, finance, economics, management company, engineering company, say that Sydney and Melbourne will continue to decline throughout 2019, potentially 2020. They believe it will drop by between another 5 and 6% in Sydney, maybe a little bit softer in Melbourne. That will represent the largest decline of property prices in Sydney in 30 years in one period of decline, which I think is a cool thing. Like, anybody that doesn't believe that the Sydney market was completely fucked and overcooked over the last few years, again, has been living on a rock. If you bought at that time, as long as you're not planning on selling it for the next 10 years, cool. If you bought and are freaking out and exiting, then that's when people can lose money. So just remember that. They believe that it's so funny listening to this stuff from these guys, because KPMG is just reaffirming what Deloitte has been saying, what Ray Dalio has been saying, Phil Anderson's been saying, Warren Buffett's saying, is that asset prices are expensive. We're at a very close to the top mid-cycle slowdown point. We're probably already in that in Australia, I believe. And by 2021, Michael Matusik's been saying the same thing, is that this correction in the share market will occur. Property prices in Sydney and Melbourne will continue to decline. I think in many other parts of Australia, they'll stabilise, or maybe the fear will spread through the market and it will go flat or decline a little bit. But by 2021, KPMG is predicting to see Sydney start to increase. They're saying about 3% in that year. So cycles happen.